Love this podcast? Support it and sponsor today. Simply head to ozcastnetwork.com for details.
The information contained within this podcast does not consider your personal circumstances and is of a general nature only. You should not act on it without first obtaining professional financial advice specific to your circumstances.
Paul Atherton is an ex-Wall Street advisor on a mission to help young people win back their financial power, wealth and security. He does this by helping them understand the hidden world of finance, risk and investments, helps them figure out how it impacts them, and to seize the opportunities to make it work to their advantage. This is Paul Street Journal. Good morning, Paul. I was just wondering if you could explain to me what a stock was.
That's a great question, Tim. What is a stock? Well, I guess at its basic level, a stock is a piece of ownership of a company. That's why on Wall Street, they call it equity. You own an equity in the company. Trading desks are called equity desks. They're not called stock desks. So it's equity. So let's run through a little bit of an example. So if you own 100 shares of, say, Apple Corporation, you own 100 shares of the number of outstanding shares in the company. The number of outstanding shares for Apple is quite significant. It's 861 million shares. In other words, if you own 100 shares of Apple, it is a very, very small amount of equity. Now, if the company does well, then the entire stock value of the company is worth more, and your piece, however small, is worth more. The stock price for an individual stock has gone up. So a company becomes more profitable. All equity owners, whether you're 100 or 1 million owners of shares, all stock owners become richer. And as their stock of Apple, in this example, it is worth more. When an individual purchases a stock, they are investing. And when a company sells stock, they are raising money to gain revenue to build, invest, and grow the company. So let's talk about stock price. Well, the price of a stock will go up and down based on two main factors. There's a lot to it, but let's focus in on these two for the moment. The two factors are its current earnings and, secondly, its expected future earnings. So you might have a company, for example, Amazon, that might be losing money, but it's growing so fast that expected future earnings is very, very large. Amazon, in other words, has a high price to earnings ratio. And by the way, I believe Amazon is actually making a profit now, but this was the case certainly some years back. And the higher the ratio, the higher their expectation is on future earnings versus the current earnings. And this might be the single most important measure to look at when buying a stock. It's called the price to earnings ratio. And then you should ask yourself, does this correctly reflect the value of the company? Or would I expect the future earnings might be even bigger? Think about Apple before the iPhone or Apple before Steve Jobs returned. You can bet that the future earnings ended up much larger than the price earnings was at the time. But you buy a stock on the stock exchange, and there are a number of trading platforms where you can buy stock. You can buy them from an online account. You would have to set up a brokerage account. You could buy them through a bank. Again, you would have to set up an account with the bank. Or you can buy the stock through a stockbroker. So there are a number of avenues where you can buy stocks. For first-time investors, I would encourage the use of a bank. Set up an account through a bank. If you're internet and computer savvy, you could certainly do that through an online account. But again, I would get some guidance through this. So that's it, Tim, and thank you very much for your time. And I hope that's cleared a little bit up the way for what a stock is and how it's valued.
Paul Street Journal.
Love this podcast? Support it and sponsor today. Simply head to ozcastnetwork.com for details.